What I want to talk about today is something we see quite a bit with real estate investors and business owners, and it is often a cause of frustration. It has to do with taking out a cash value life insurance policy when you are interested in funding the policy and then borrowing from it. You want to take money from the policy, invest it in your business, acquire more real estate, and you like the idea that once money flows through the cash value of a whole life insurance policy, it's forever at work for you. It continues to compound. A beautiful feature to a life insurance policy, and frankly is why so many people buy it. But where people get frustrated here and ask the question like, why would I do this? Why would I put money into a policy? Has to do with the fact that if I actually measure what I am growing by in the cash value, what it's earning could be 4%, and then I look at what I'm borrowing at, it's 5%, it's a negative spread. Meaning I look at my policy, I say, wait a minute, when I actually crunch the year-over-year growth, I'm earning about 4%. But when I borrow against it, the cost to borrow is 5%. It's costing me 1%. Whereas if I had my money in the bank or leveraged from another source, I would be in a much better position because it wouldn't cost me anything. I could just take money out via cash from my bank account and make a property purchase. And yeah, you could argue that, hey, it's no longer compounding if it's in a bank account. There's pros and cons to everything. But I want to address this point, and we're going to do so in the next video as well. We're going to look at some numbers. But to start, what we're going to look at is the topic of a dividend rate compared to a loan rate. We're going to discuss this. And then the net earnings rate in a policy, because this is a topic of confusion that a lot of people look at and get confused. I just spoke with someone today. He was looking to put in $1 million, $2 million actually into a cash value life insurance policy, a whole life product. And he said, hey, this makes perfect sense. I'm earning 5.5% on my money because that company's dividend rate was right around 5.5%. And now you've got that situation where you've got to provide education for, imagine, $2 million you're looking to pay in, and to tell someone that you're not actually earning 5% or 5.5%. From a sales perspective, people can be afraid to do that. Now I'm in the position where we didn't tell him he was earning 5%. A competitor did, but then at the same time, going back to business coaching, do not trash your competition. Don't do that, but that's another topic. So to get into this point, if you are earning a dividend of 6% and you can borrow from the policy at 5%, what's that sound like? It sounds pretty good. I got a positive 1% spread. And we see this marketed frequently. The thing is, if I have a dividend rate of 6%, that would tell you as a consumer what? If you've got cash value of $100,000 in your policy, and I have a dividend of 6%, or earning 6%, what should I see the cash value grow by that year? $6,000, 6% of 100 grand. The thing is, if you were to actually look at the cash value growth on a policy, look at any of our videos, you'll never see that be the case. And the reason why is that a dividend rate on a life insurance policy is always a gross rate that is credited after the company's insurance expenses, everything included in purchasing that actual life insurance policy. No matter how low we drive the insurance expenses, which we always minimize them. So what I want to look at is not the gross rate, not what's on paper, but the net numbers. The insurance company will refer to this as the IRR, which stands for internal rate of return. And the net numbers might look like this. I'm earning 4%, which is a safe return, safe internal rate of return. The money's liquid. I can access it anytime I want. It's also tax-free. If I do things right, if I don't trigger a taxable event, a MEC, anything like that. So 4% is not bad at all for a safe place to position money, especially when 4%. But why would I put money in here if I'm a real estate investor and I want to use this product to buy more real estate when I'm earning 4% and it costs me 5% to borrow? Doesn't make sense. And if that's the pain point, that's the objection. A quick tip for agents out there, don't try and force the issue or say you don't understand, you've got the compounding on everything. You've got to address someone's objection the same way you would want it to be addressed. So here's how I look at it. How do I improve this? Because the reality of it is, if I'm earning 4% on a policy, that's what I'm earning. So if I've got 100 grand in cash value, compounding at 4%, and I borrow out half of it, $50,000, what's going to happen with the life insurance policy, we're going to look at numbers in the next video, is the $100,000 I had, I pulled out $50K, you still receive that 4% on the full 100 as if you never touched it in the first place. They do that by charging a loan interest rate, in this case 5%, and also collateralizing the death benefit. So that's how the company does it. But when you borrow out that $50,000, it costs you 5%. So on the $50,000 outstanding, I'm earning 4%, and it costs me 5%. That's a negative 1% spread, not a positive 1% spread. So how you can improve this, and what a lot of people are doing right now in the present environment, is as follows. I'm going to go through two options here. What they're doing is the second option, or they're leveraging it or considering it as an option. So option one is a direct policy loan. This has to do with flowing money into a life insurance policy and really doing this. So I have 100 grand in cash value. I pull out 50. What's the disadvantage? There's a higher interest rate, 5%. But the advantage is I have full control of my money. With life insurance policy loans, I don't have to qualify for them. I don't have to pay them back if I don't want to, unless I borrow out too much or almost everything. I don't have to pay it back on any schedule. I've got tons of flexibility. You, as the policy owner, are in full control of how and when you elect to pay that policy loan back. That's the advantage there. Disadvantage, again, is the interest rate is high relative to what exists in the marketplace right now. So a nice alternative is as follows: cash value collateral loans. Call it a line of credit against your life insurance policy. The cash value, not the death benefit. So huge advantage here is that the interest rate is 3%. Approximately. You might see them between 3 and 3.5%. In fact, some companies have lower rates than that, or I shouldn't say some companies, some banks do, but that's a good topic for another video. We've got videos on this. Just to summarize what this is I take a cash value collateral loan, that is, I take my policy to a bank. I say, hey, I've got 100 grand here in cash value. I'd like to assign it to you, the bank, as collateral. And the bank says, thank you. Here's a loan, a line of credit for, call it $100,000. Now, when I actually receive that line of credit, the interest rate may be 3%. I can borrow against it at my leisure, just like a HELOC against a piece of property that I might leverage. A big difference is that the underwriting with these products or with these cash value collateral loans is typically very minimal with banks. They rely heavily on the life insurance underwriting when we first take out a policy, and they understand the cash value life insurance product. So it's a quick approval process, usually 1 to 2 weeks from what I've seen, not extensive. I don't have to provide a bunch of documents and all that stuff like any other bank loans. Line of credit type loan. Now, the drawback here, give up a little bit of control. When I have a loan outstanding, I must make interest-only payments. It is a loan with a bank. And then also, the loan terms for the line of credit is typically, depending on the lender, 5 to 7 years. And really what that means is when I take that loan out, it may be intact for, call it 5 years. At the end of 5 years, the bank may want to review or assess my situation again and put me through the initial underwriting, which again is a 1 to 2 week process. But at the end of 5 years, if they say, hey, as a bank, we're not comfortable with these types of loans anymore, they could pull it and say, hey, we'd like our money back. You have to pay it off, borrow from the policy to pay it off. However, does that happen? No, but it's good for awareness. But in any event, it's a nice option to be aware of, because now all of a sudden, if I've got a bunch of money in cash, which we see a lot of people in this situation, where they say, I like my cash because it is liquid. When an opportunity pops up as a business owner or a real estate investor, if I have cash available, that gives me the ability to move quickly. Now, that's the advantage. The drawback is what? I don't earn anything. Maybe it's 1% if I've got a huge amount of cash and I'm a premier account holder at Morgan Stanley or something like that. But for the most part, pays next to nothing because I have the liquidity. So that's the drawback. Now, the advantage to a cash value life insurance product, which is exactly what banks do, by the way, is I actually see it earn. When I say exactly what banks do, if they've got money sitting there doing nothing, they can position it in a product where they actually see it grow year over year. That, by the way, is a tax-free yield as well if I don't trigger a MEC and if I don't lapse it with a gain or anything like that. We've got other content on that. But effectively, I've got a tax-free yield, call it at 3 to 5% if all things are set up properly. And now I can borrow at 3%, maybe even better. Maybe it's 2.5 to 3.5, whatever it might be. But I can borrow at 3% while I'm earning 4. Now I've got a positive spread. This is tax-free. If this is for business purposes, this loan, which if it's for a business or a real estate investor, it often is, that can be classified as a business loan and then be tax deductible. I always check that with the bank or your CPA, as we are not an accounting firm, not giving out any tax advice, nothing like that. But wanted to provide some awareness on that because this question comes up. Why would I put money into a policy? And this is often the only option shown. Typically, it's the option on the left. And then an investor or a business owner figures this out on their own and says, no, I'm not doing this. It doesn't make sense. Or they find out after it's too late and then they get frustrated. My point, though, is how do I improve this? If I can be shown options, that may open up my mind to say, okay, yes, I want this, but the numbers have to work. Now, all of a sudden, this makes sense. So we're going to look at some numbers in the next video. Hope you enjoyed this video. Please hit the like button, subscribe. And as always, I hope this helps. Talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.